Volvo is the latest EV maker to embrace Tesla's charging design, further bolstering the EV maker's dominance in the charging space. Guggenheim Securities Vice President Ron Jewsikow in a note saying Tesla's charging partnerships could prove profitable, but not enough to justify the stock's current price. He joins a group of Wall Street firms skeptical of sky-high Tesla shares and skeptical if they're worth their hefty price tag. Ron Jewsikow of Guggenheim Securities is joining us right now. Ron, thank you so much for being here. And this is something we've been talking a lot about and trying to sort of sift through what exactly Tesla gets out of this, of all of these partnerships, right? Monetarily, financially, what it's going to mean for Tesla. What is your analysis telling you?
Yeah, we put out a note earlier this week for clients, kind of outlining the charging business going out to 2035 and looking at the number of electric vehicles we expect to be on the road, just close to 80 million. And what market share Tesla will have, which we think is 50% plus. And ultimately, our analysis showed that the charging business could generate something like 50 cents of earnings in 2035 in the U.S. And while that's still a meaningful amount of earnings, it's tough to justify the move in the stock based on that. We get something like $10 per share of value to Tesla based on all of the charging announcements. And the stock since the initial Ford announcement has went up about $70 per share. So it's a bit tough to square.
The netting of these partnerships, is that a net positive for Tesla, or is it more so something that is to the benefit of the other companies in traditional auto manufacturing that have been able to step into these charging partnerships with them, Ford and GM?
Yeah, I think it's still an open debate. Obviously, the economics of the charging business flowing to Tesla will be a positive. I think, and we've written this for several years now, that the supercharger network is and will remain one of Tesla's largest competitive advantages. It's a fast, reliable charging network that consumers love. And these partnerships allow access for other manufacturers that specialize in building vehicles to have access to those chargers. And it's been publicly disclosed that Tesla is not going to be charging extra for owners of other vehicles, whether it's GM or Ford, who are part of this partnership. So I think that those OEMs customers having access to the charging network could ultimately lead to share losses for Tesla. But I think that's a time will tell kind of situation.
Ron, you talk about that the case for this charging network doesn't justify the price. Of course, many of your rivals at other firms who are still bullish on the stock, it's partly because of the charging network, but it sort of has to do with the stuff that always has to do with why people like Tesla, right? Sort of grand ideas of what it is going to be, whether it's an autonomous taxi owner down the road or whether it's going to start licensing its software and technology, what have you. What do you think of those sorts of concepts of what Tesla will be?
Absolutely. It's a great question. I think on FSD specifically, I think our view has been for some time now that as a level 2 plus system, it's very attractive and can be a very good business for Tesla. We have nearly $100 billion of ascribed valuation in our DCF for full self-driving as a level 2 plus system. Where we have trouble bridging the gap is to robotaxis and the market confidence in robotaxis. I think we've seen that progress in FSD has been slower than Elon Musk has expected, and with it's really tough to understand where the market's confidence in robotaxis come from. You hear things like data, but the application of that data is tough. You need a lot of compute on the vehicle to utilize that data effectively, and I think it's reasonable to be skeptical if the current vehicles with so-called hardware 3 have enough compute on the vehicle to effectively get to actual robotaxis.
What is Tesla actually monetizing its data look like in practice, Ron?
I don't think they really will monetize the data unless we're talking about licensing FSD, which I think most OEMs have their own strategies around ADAS level 2 plus. beyond that, I think monetizing data is pretty tough in automotive. There's been companies that have tried to do it, and it has been a struggle. But beyond that, I think the licensing FSD would be the main avenue. I just think we're skeptical that other OEMs would actually opt in to FSD when there's viable public alternative or viable alternatives from other suppliers that can offer level 2 plus systems competitively.
Certainly. Yeah, we'll be watching. Maybe something on FSD, maybe something on the insurance front as well. Ron Jewsikow joining us here today, Guggenheim Securities Vice President of Automotive Equity Research. Thanks so much for the time here, Ron.
Thank you.